Good morning and welcome to the show today. Welcome to the Financial Turmoil Explained channel. Today is Wednesday, the 24th of August, 2022. Thank you for tuning in. I'm glad to have you guys here. Now let's get started. I want to talk about China today and the impact it could have on our economy. China. Do you hear a flushing sound? Of course, yeah, it's halfway around the earth on the other side of the earth, so you don't hear it real loud. But that's what's happening with the Chinese real estate. We're looking at an $8 trillion industry. And it's been built up over the years with Chinese have a philosophy, see. One of the things about it is they want to get married and they want to own a house. Or own two houses. And this is very important to them. And so they'll go out and they'll buy houses before they're even completed. These property developers have sold a lot of houses that are not even completed. And they also have something that they call wealth management products. So even people that don't want to buy a house, yeah, they'll take your money and they'll pay you a high rate of return on something called a wealth management product, which is basically a overblown Ponzi scheme, where it relies upon them bringing in more wealth, people wanting to invest in wealth management products. We got the same thing going over here. We've built up all this leverage in the system too, just like the Chinese, but the Chinese is now starting to pop. Very similar to what happened to us in 2008 with the mortgage-backed security crisis in the real estate market. It's happening right now in China, but China is the second biggest economy on earth. And we might be able to fare through all of this, except we're starting to turn over now too. The Federal Reserve is basically pushing us off the cliff. They don't have to, but they want to. They're doing it on purpose. I can't say anything else but they're going to have a Jackson Hole meeting this Friday, and with these new policies of being ultra tight, $95 billion a month they're going to pull from the economy with quantitative tightening, they're just going to push us off the cliff. So you get simultaneously two effects happening at once. One, the Chinese real estate market rolling over, and basically a real estate crisis similar to what we had in 2008 with a lot of bankruptcies occurring in China. That unfolding at the same time that the United States economy is going to be stepping downwards could create a massive plunge that could put us not into a recession, but could put the entire world into a depression. And ultimately, what's that going to lead to? Well, the Fed has told you that they're data dependent. They will try to turn the whole thing around, and when they do that, then our dollar is going to lose value like you've never seen it lose value before. So on the front side of this, you might see a little bit of I wouldn't really call it deflation. Well, it could turn into deflation, but disinflation. But then it's going to turn into profoundly high inflation on the backside of this. It's like a storm, you know? When a hurricane hits, you get the front side and the winds are going that way. And then when the backside hits, the winds are going the opposite way. That's how it rips trees out of the ground. And so if all of the people that are middle class are like trees that are in the ground, this thing's like a hurricane. First it's going to hit you in one direction, and then it's going to switch and hit you in the opposite direction. And that's how it rips your roots out. That's how you end up being in poverty, even if you're well rooted. This thing is really, really nasty. And when's it going to all be over? Well, the same thing, very similar, happened back when they wrote movies like The Grapes of Wrath, and way back in the 1930s, people went through things like this. People went through world wars too. So this isn't new in history. This has happened before. It's not unprecedented. But the magnitude of it, it's an awful lot of uncertainty going into the front side of this. And we're going to have to let it play out before, on the back side of this, when we look back in retrospect, when things start to get better, then we'll look back and we'll say, whew, we survived through all that. That was rough. Anyway, let's get started. Let's open up the charts right here and take a look. China's property market is in free fall. What does this mean for the world economy? The sector is dangerously overheated, but unlike the 2008 financial crisis, the global ripple effect is likely to be limited, they say. The property sector in the Chinese economy has been something of a puzzle. At its peak, it accounted for a quarter of the nation's economic output, broadly measured, and it sees people in Beijing and in Shanghai paying house prices similar to those in San Francisco and New York, despite having just a quarter of the income of American buyers. So basically what they're saying here is we're looking at an $8 trillion market that's starting to collapse. And they're saying that, I'll read it clearly here again, that the ripple effect is likely to be limited to the global economy. But there is going to be a ripple effect from this. And it's going to be a big ripple effect. And like they say, it could be limited if it wasn't for the fact that the Western economy over here is getting ready to collapse too at the same time. That's going to exert an awful lot of extra pressure. One's going to make one worse, and the other one's going to make the other one worse. So it's a compounding effect, you see. Let's take a look at the silver price today. $19.15. It's up 4 cents on the day so far. It is trading in a range right now between roughly $18.80 and $19.25. And it's on a little bit on the high side of that range right now at $19.15. Let's take a look at gold. Gold is at $17.53. It's up $4.90 on the day so far. So gold is on the high side of its range right now at $17.53. Cryptocurrency today, $10.31. So it's just staying over $1 trillion for the industry. That's the entire industry. Bitcoin today is 21,474. And we're looking at Ethereum at 1,649 or 1,652 right now. Dow Jones Industrial Average 32,971. It's up 62 points on the day so far before the Jackson Hole meeting. I don't expect any good news for this market until the Fed actually does change direction. And they're not planning on change direction really until they're forced to. And it's going to take a lot of bad news before the Fed is going to say, hey, okay, we told you guys we were data dependent. And now the data's turned sour. And now we are going to start to withdraw we're not going to do our quantitative tightening any longer. We're not going to do, in fact, we're going to start a new round of quantitative easing. When you see that day happen, then that's going to be good news for the Dow. But that ain't going to happen until they're forced to do that. So we're going to have to go through some real pain. And they've told the market we're prepared to take pain in the market, but I don't believe they're telling the truth. But the market is going to go through some pain. That's going to turn them. Because they really don't want to turn everything down. They want to bluff at all this stuff that they're doing. But their bluffs are going to start to turn into realities very soon. And then they're going to have to turn around. They're trying to support the dollar right now and continue to maintain the dollar's purchasing power. But it ain't going to work ultimately because it's all a bluff. But so far they've gotten away with it. And they're going to get away with it as long as they possibly can. They're keeping a finger on the pulse. And they're trying to get away with it as long as possible. And Jackson Hole is I think, going to start to tip everything downwards, because the markets are finally going to realize, hey, you know what? They're going to continue with this until they wreck things. And they're going to start to wreck things. And that's why I'm half expecting a downturn following what's going to happen on the meeting on Friday and into Monday. It could be a very black week for the markets coming up. When the markets start to realize, hey, the Fed ain't going to turn until they wreck the markets. And the markets have been thinking all along, okay, the Fed's bluffing. And yeah, they are bluffing. And that's what makes the markets think that they're bluffing. But ultimately, they're going to continue to play this bluff until they can't. And the markets are going to determine that. So it's like a catch-22. Really, that's what it is. Taking a look at oil today, it's 94.38. It's down up 64 cents on the day so far. Oil's starting to get hot again. We did have a period in time when it was down in the 80s. Now it's back up into the mid 90s and headed toward 100. Headed toward 100, I should say. Move index 133.85. And so I don't have to get a whole lot higher than that with the move index to start having problems or instabilities in the credit market. Seems to me, if we go back here with the move index and take a look, let's take a look at the 5-year chart. You can see it right here, this bounce in the move index, where it went up to about, well, almost 150. It was that bounce that triggered the repo market madness back in 2020, back around 2020. It was that bounce, see that spike right there. That's what triggered the repo market madness with the Fed at the repo window and everything. I mean, at the overnight window. Right there. Now look, we've crept up until we're almost up as high as there now. Close. Not quite that high, but getting right up there. We've been creeping up all year. And that's the instability in the credit markets. Let's take a look at bonds and rates today. And yeah, we are seeing bond yields explode to the upside. Look, 3.1 on the US 10-year. Now, 3.25 is a marker that I've had put in for like the last 3 or 4 years. I've told you guys, 3.25 is kind of like and I mean, just like we were in the 2s there just a few days ago. Now we're at 3.1. It's not very much further till 3.25, especially when we're rising like this. So we're at 3.1 right now, up 4.8 basis points, and the US 30-year is up 3.9 basis points at 3.29. And now let's finish off with the US dollar index at 108.50 on the US dollar index, which is basically kind of going along sideways. Yeah, we get a little bit of volatility, a little bit of a bounce there, but basically, you see, if you look through all this chop, it's kind of going sideways across the board, more or less today. Thank you guys for listening to the show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.